get started. Good afternoon, everyone, and good morning to those of you who are in the central and western parts of the country. My name is Jim Scanlon. I'm the head of relationship management here at the firm. Welcome to our monthly strategy update and market outlook webinar for March. As we head down the backstretch here in the first quarter, the markets have mostly held on to earlier gains from the year. The S&P is up about 4%, the tech-heavy NASDAQ up 10, and the Dow trailing the pack at about negative 1.5 for the year. With last year being the worst year for equity since 2008 and fixed income having posted 2 consecutive losses, the first time ever, we know most investors remain concerned, confused, and worried, which is why we believe, since we started the firm, that communication is such a critical component to the portfolio management process. We take deep pride in providing our clients with information which helps them not only understand what's going on in the markets, but what the changing economic conditions specifically mean for their portfolio. We know clients want to know what's in their portfolio and why, so we talk about it. It's remarkable how often I hear from advisors telling me that other managers either don't or won't do this, or if they do, it's not overly meaningful. Despite the various headwinds, which Jim will be talking about momentarily, we do see opportunities. However, finding them requires skill, patience, and a lot of research, hence the title for today's webinar, Sifting Through the Rubble. I'm joined, as always, by our head of research and co-portfolio manager, Jim Warner, who will walk us through the changing landscape and how we're positioned to face the challenges and take advantage of opportunities. Before I turn over to Jim, just a reminder, we welcome and encourage your questions, and so please click the Q&A button at the bottom of your screen at any time during the presentation, and we'll address those at the end of the session. So with that, Jim, I'll turn it over to you.
Great, thanks, Jim, and thank you everyone for attending. Well, let me share my screen as I always do, and we'll get right into it. Okay, it should be coming up on your screens at this point. So again, good morning, everyone, and thanks for joining me on another monthly strategy update. Once again, I am trying out a new, more condensed format for this presentation, and I'm also focusing on specific things that we're doing within portfolios. So the feedback on last month's presentation was great, but I'm always looking for ways to make this presentation as useful as possible to you. So feel free to provide feedback after this call. And I'd like to hear from you anyway. As you may recall, one of the other goals of this new format is to provide more time for questions. So please ask away. They're all anonymous, these questions. So when we get to that Q&A session at the end of the presentation, feel free to sling away with your questions. So with that said, let's get into today's monthly strategy update, which is entitled, as Jim said, Sifting Through the Rubble. As you can tell from the title, we are getting modestly more positive and are finding some real value in stocks that have been cast away over the last year. In February and entering March, we got another pullback in this seesaw market. To some extent, the slight pullback in market indices was simply an exhausted bear market rally taking a breather. Interestingly, the relative performance of the key indices broke with recent tradition. The NASDAQ actually outperformed the S&P 500 and the Dow despite interest rates rising. This is a very good sign in our opinion. It would seem to signal that the market is more focused on fundamentals than purely valuation. This fading convexity, which is just another way of saying that the market is now less sensitive to changes in interest rates, is a good sign that we think is a signal to start sifting through the rubble of growth and technology stocks and begin modestly adding those types of stocks to the portfolio. The other sign that it's time to start taking a bit more risk is the VIX. You can see it on the lower right on this chart. Stock volatility has stabilized around 20, which, as I have mentioned many times before, is a key level below which is generally conducive to taking more equity risk. Since our last call, there have been several economic data points that have pointed to an economy and inflation running a bit hotter than expected. The services PMIs, as you can see from the chart on the left, are both solidly in growth territory, and core PCE, which is the Fed's favorite inflation metric, actually ticked up. The market interpreted these data points negatively because they imply that the Fed will have to raise interest rates even further, and that could increase the chances of a full-blown recession. Of course, the market doesn't wait for the Fed. The yellow line on this graph is where the Fed funds curve was a month ago. The blue area is where it is actually as of yesterday, or the day before yesterday. It's even higher now. So you can see that the market has moved up its expectations for the Fed to stop hiking around 5.5%. It's probably closer to 5.75% as we sit here today after Powell's comments yesterday. But this is up from 5% just a month ago, which is pretty dramatic. In addition, the market also increased interest rate expectations further out the curve, which is now much more in line with Chairman Powell's comments that he expects rates to raise rates and then keep them high for a while. So the rest of the interest rate market followed suit. The 2-year T-bill is now hovering just over 5%, and the 10-year Treasury note briefly breached 4%, sort of hovering around 4%. In our opinion, I think we are at the higher end of the trading range. What is driving this view is that I don't believe the January economic data points were really as strong as reported. Remember on our last call, I pointed out that the huge beat in payrolls was driven by an exaggerated seasonal adjustment. The Wall Street Journal actually had an article out yesterday that discusses these seasonal adjustments that, in short, reiterates the point I've been making about how the economic volatility caused by the pandemic and how it was addressed through fiscal stimulus led to these wild seasonal adjustments. We've seen this before. The seasonal adjusted data is simply fuzzy and not particularly reliable right now. My gut tells me is that this sort of issue bled into other data points. So let's just say that I won't be surprised at all if the February data comes in weaker than expected. All right, so if we look at the Citigroup Economic Surprise Index, which increases if economic data comes in higher than expected and declines when it misses. It's the orange line on this chart. And compare it to the S&P 500, which is represented by the black line. You can see that during the first half of this year, the first half of last year, when economic data was weaker than expected, the S&P declined and vice versa. That relationship flipped during the last few months as the market has become more anxious about the economy running too hot, and that in turn would lead to more rate hikes and thus more risk of recession. That is precisely what happened last month. So I wouldn't be surprised if the February data we get in the next few weeks is weaker than expected and it sparks another rally. Turning to the S&P 500, it was an interesting month from a technical perspective. Despite the small pullback, the index remained above its bear market downtrend. It also successfully tested its 200-day moving average. These are good signs. Another good sign is that the market is making higher highs and higher lows. As for the next couple months, we don't have earnings seasons to worry about, and the market is generally seasonally strong during the March to May period. So there's a good chance that we stage a little rally. However, the S&P's forward earnings per share estimates have only decreased by about 6% from the peak, and the market is still trading at 18.5 times, which is a bit elevated compared to historical levels. And we still have a bit of economic uncertainty ahead. So there are mixed signals indicating that it's not time to get super aggressive. Turning to the NASDAQ, it too remains above its downtrend line. Technically, the jury's still out on if this break is going to hold. But as I mentioned, the biggest positive sign to me this past month was that it held in quite well despite the surge in interest rates. And when you consider that there is less economic cyclicality in the companies that comprise the NASDAQ composite, it feels like this is the place to start looking for opportunities. So how is this all impacting our portfolio? Since our last call, we've gradually moved some excess cash into stocks, and specifically into beaten up technology names. For months, we have been conducting due diligence on a host of stocks that were hit very hard over the last year. This included a number of growth stocks in the tech sector. Now, you may be asking yourself, didn't Jim warn us about trying to catch falling knives last month? Indeed, I did. But what I didn't mention was our framework for minimizing any potential losses. First, the stock has to be really beaten up already, and it needs to show a basing. Secondly, the underlying business has to be healthy, and management has also demonstrated a focus on improving free cash flow generation and controlling spending. And then finally, the valuation needs to be super attractive. If we stick to this framework, we're likely to find asymmetrical risk reward opportunities, or said another way, find stocks that have vastly more upside than downside. And during this process, we found 3. So during the last month, we added Expedia Group to our flagship global vigilance moderate strategy, and also to the aggressive version called Tilt. Expedia, as you probably know, is a leading provider of online travel services. It currently is benefiting from the global recovery in leisure travel. An overlooked but important development is the completion of a multi-year IT system overhaul. Not only will this increase operating efficiencies, but it will enable Expedia to create a common loyalty program across all of their brands that include Travelocity, Orbitz, Hotels.com, eBookers, and VRBO. Already, customers who are participating in this new loyalty program are 2 to 2.5 times more profitable existing customers. So this creates the possibility that Expedia could experience not just accelerating revenue growth, but also expanding margins. And we're buying it for just 6 times enterprise value to EBITDA, which is really cheap, and on an absolute basis, as well as relative to Expedia's historical trading range. So we're really excited about this investment. Another stock we recently began buying is Sea Limited. Sea is a leading internet company principally doing business in Southeast Asia. First off, we are quite bullish on the Southeast Asian economies. With China finally reopening from their COVID-induced restrictions, the entire region will benefit as GDP growth rebounds. Sea will likely see a reacceleration in its e-commerce business and digital payments segments. As you can see from the chart, Sea has endured a brutal round trip back to its pre-pandemic levels. We might be a little early on this one, but we think the stock will work as the market recognizes its reacceleration of revenue growth and appreciates management's new focus on controlling investment spending to enhance free cash flow. The final new stock we recently added is Zoom. We have been patiently watching Zoom for over a year. Zoom obviously came to fame during the pandemic, which caused both its business and stock to experience meteoric rises. But soon, growth slowed as workers returned to the office, and the valuation compressed dramatically, along with many other growth stocks. Overlooked, however, is Zoom's world-class communication platform, which has many new features to compete against Microsoft Teams in the enterprise market. So even as some individuals and small businesses have abandoned Zoom subscriptions, the much more profitable enterprise business has become the engine of growth for the future. Later this year, revenue growth will reaccelerate, and that we believe will dramatically change investor sentiment. And at just 10 times EBITDA and 20 times PE, we think we are buying at an attractive multiple. And if we're wrong, we think there are a number of potential acquirers for this business. On this slide, we present the Global Vigilance Moderate Portfolio, our flagship strategy, visually. The size of the boxes are based on the size of the position. I'm not going to go through this page in detail, but it's a pretty clear representation of the investment themes that we like today, and we'll send it out with the rest of the slides after this call. And we can also come back to it if you like during the Q&A. So I'll finish the presentation here with a summary of our portfolio strategy. We still think that the stock market is going to be a bit volatile through the summer as it transitions into a new market cycle. So our mantra is still be patient. But as you heard previously, we have been sifting through the rubble of technology and growth stocks and are beginning to add exposure in select stocks. So let me stop there and take some questions. Jim?
Great, Jim, thank you. Let's see if we have any questions here? Just give me a second here. I'll open that up. Okay, we've got a couple questions here, Jim. First question, what are your current views on Europe?
Sure. So European stocks have had a terrific run over the last 6 months, largely because the market feared a deep recession and an energy crisis, which never really materialized. A lot of that was due to a much warmer winter, which in our opinion is completely unpredictable. So what Europe has experienced is more akin to a relief rally. That said, we are seeing some improvement in manufacturing and service PMIs. And so we are looking around for opportunities in the EU. But one concern we still have is around energy security. Next winter, we think is going to be really present a tough set of issues from an energy perspective, as the Russian energy fades away, and there just still isn't enough importation of LNG.
Okay, great. A couple more. What might be a headwind that most others are not considering at the moment?
Well, I mean, your mind can just kind of go wild on that one. China could invade Taiwan. That would be a huge headwind. There could be greater involvement by European countries in the Ukraine-Russian situation. Both we think are probably very unlikely. There's obviously the most obvious thing that comes to mind is the debt limit. I guess the question that sort of would concern us the most would be if the U.S. were to default on its debt. We don't believe that will happen, partly because we think there's too many adults in the room. That said, there is a real spending problem in Washington. In case you didn't see it, the CBO released a study that indicates that the budget deficit over the next decade is increased by $10 trillion. And the Freedom Caucus, the budget hawks on the Republican side of the aisle, these are the same ones that held out on McCarthy's speakership, are demanding some serious budget cuts and are using the debt ceiling as a proverbial hostage. So I would expect that you're going to see, a big political high wire act. But I think in the end, putting the country in some form of default is not in the best interest of any sitting politician. So, if I stop and think about what is kind of the biggest headwind, that's it. I think the other thing I would point out too, as we've mentioned in previous calls, when people talk about recession, we think that what we've had is kind of a rolling recession. Technology is already in recession, right? They've already seen their stock prices, really collapse. You've seen some deceleration in the businesses. You've seen layoffs, right? These are things that happen during a recession. You've also seen that in some of the goods producing companies, and I've talked a lot about how we think that the goods part of the economy is already in recession. So it really leaves the services part of the economy, which appears to be super strong. But that's what we're focused on to see if whether it's increased inflation or the higher interest rates really do cause a growth problem in the services part of the world.
Okay, great. Another couple of questions here. There have been several analysts with a doom and gloom outlook saying we could be down another 20% sometime this year. Do you see that happening at all?
Well, it's entirely possible. As I pointed out earlier, the earnings estimates for the S&P 500 just really have not come down very much at all. We just got through earnings season and guidance actually was a lot better than feared. And so, could you have some form of a correction in those earnings estimates to bring the market down? Absolutely. There's no, we're not fully sure what the impact is going to be of higher interest rates yet on a lot of business models. Secondly, I would point to the fact that the market typically trades around 16 times. And so for it to be at 18.5 times, as I mentioned earlier, we can simply correct down to 16 times. And, that wouldn't quite be a 20% correction, but it'd be pretty close. I mean, it'd be about a 10% correction. And so, the market absolutely could go down from here, which is why in our portfolio and in virtually all of our portfolios, we're pretty conservatively positioned. And our flagship strategy has never been this conservatively positioned. We're about 50% equities, and the rest is largely fixed income. So I mean, we're clearly not saying that this is the opportunity to go buy the market. You may get a better opportunity.
Okay. Another question just came in. What about the interplay between the weakness in dollar and the European relief rally? Do you think capital flow will continue to follow?
Well, yeah, but the dollar's actually been strengthening in the last couple of weeks, and I do think that that's going to have an impact on flows to Europe. But we've been watching the dollar very closely. We thought it got a bit too strong towards the end of last year. It corrected a bit, and now it's kind of finding some stability. Look, as long as interest rates keep climbing higher and higher here, which honestly we don't really expect, but we think that interest rates are pretty close to where they're going to settle out. But as long as they remain relatively a lot higher than Europe, then the dollar is going to remain relatively a lot stronger. So we're not buying into a whole big dollar weak thesis that a lot of people talked about at the beginning of this year. So I think we're going to have to digest a few more economic data points before we can really say for certain that we're going to have dollar weakness.
Okay. One final question here. An advisor saying a lot of clients are talking about why not just invest in a short-term 1-year treasury at 5% call it a day. How would you respond?
Yeah, I mean, we're getting that question a lot, and I guess the way I would say is depends on who you are. So for the conservative investor with no need to grow their portfolio, that's absolutely a possible strategy. However, I would note that when adjusted for inflation, that investor would just sort of be keeping up. So while 5% sounds like a lot today, because we've been living through 10 years or more of a zero interest rate environment, on a inflation adjusted basis, it's frankly not getting you a whole lot. What it is getting you is safety, of course, which is another reason to have some measure of exposure. And so for the rest of investors, our preferred portfolio strategy is to barbell kind of conservative bond positions like T-bills or even mortgage-backed securities or investment grade debt with equities that offer much higher returns over the long term. And and what it really comes down to is rather than if you have a longer term view on achieving your financial goals, I think that there are some really beaten up stocks that you need to have in the portfolio.
Okay, thank you. And then one last question just popped in here. Can you review the themes page and indicate if there's any way to tell how long you expect each theme to continue?
So you're asking me if I have a crystal ball. Yeah, so let's go back to this. So I listed out here some of the key investment themes in our portfolio: artificial intelligence and digitalization of the enterprise. These are decade, maybe multi-decade type secular themes that that we're really attracted to. We have been. This sort of comes into, we've been essentially underweight technology for the last year, which has helped. But, and as we start to sift through the rubble, as I mentioned earlier, we are attracted to a lot of the names that are represented in those themes. Another very big theme in the portfolio is energy infrastructure. And I guess I would probably couple it with the next one, which is transition to renewable energy. There are some enormous opportunities for whether it's generation of renewable energy or electricity based on renewable energy, or even in areas like biodiesel that are heavily influenced and aided by the Inflation Reduction Act. And so we've been actually fairly aggressive in tackling those opportunities Not only because we think that that's a terrific trend for the next 10 years or so, but it's also it's not very cyclical. And so it allows us to take some opportunity and add some equity risk to the portfolio that we think is, got some legs to it. The other big area that we have is mortgage REITs. We think that kind of the unprecedented amount of volatility and the never before seen, increase in the speed at which the increase in interest rates occurred last year opened up an enormous opportunity for buying mortgage-backed securities with spreads as wide as they've ever been in any crisis. This is an enormous opportunity to get substantial yield in the portfolio and may even get equity-like returns in the process. And then lastly, the growth castaways that I mentioned three of specifically earlier is a big part of where we're going in the portfolio. But as you can see just from this market map, we've been we're pretty heavy in fixed income at this point. But we are certainly looking at opportunities where, to take advantage of things, whether it's nurse staffing or pawn shops, or we have a big position in an Indian bank, which is one of the fastest growing economies in the world. These are the types of things that are catching our eye today.
Great, Jim. Thank you. That'll do it for the questions in the queue. So I think we're coming up on a half hour here, so I think we'll just pick a good time here to wrap up.
Terrific.
All right. Well, thank you all for joining us today. We greatly appreciate your time. The replay will be available shortly in the next day or two. As always, we're grateful for your partnership and deeply appreciate the trust you placed in us as being stewards for your clients' irreplaceable wealth. It's an enormous responsibility that we never lose sight of, and we thank you for continuing to partner with us. So with that, have a great day, a great week, and we'll be in touch shortly. Take care.
Thank you.